Ashok Leyland is represented by Mr. Dheeraj G. Hinduja, Executive Chairman, Mr. Gopal Mahadevan, Full-Time Director and CFO, Mr. K.M. Balaji, Deputy CFO. We'd like to thank the management for taking time out for the call. I would now hand over the call to Mr. Hinduja for his opening remarks, post which we'll start with Q&A. Over to you, Mr. Hinduja.
Thank you. Good morning, ladies and gentlemen. It gives me immense pleasure to be in touch with you, and I thank you very much for the interest shown in Ashok Leyland. I will quickly run you through the Q4 and full year performance, as well as some latest developments. I'm extremely happy to share that FY22 has been a year of turnaround for AL, aided by a strong performance in Q4. We have been able to post marked performance on most of the areas. Q4 was more a consolidation quarter, if I may call, post the trend reversal in Q3. I'm happy to share that after 10 quarters, our MHCV domestic truck market share has crossed 30%. In Q4, MHCV truck volumes have grown at almost 50% higher than the industry growth, resulting in our market share growing to 30.6% as compared to 28.9% in Q4 last year. Sequentially, also in Q4, our MHCV truck volume have grown 78% as against an industry growth of 47%. Our market share has grown to 30.6% in Q4 from 25.3% in Q3. Our April 22 market share was at around 30% as against 29% in same month last year. I'm happy to state that our Q4 absolute EBITDA has gone up sequentially by 2.5 times. In percentage terms also, EBITDA has more than doubled to 8.9% from 4% in Q3, despite taking into account the full impact of raw material price increases. Last year, Q4 EBITDA was at 7.6%. LCV, which was on a growth phase, has been impacted by semiconductor shortages, but on a full year, our volumes are still higher than last year. International operation sales have registered a 31% year-on-year growth in Q4, 4,173 numbers compared to 3,164 in Q4 of last year. International operation sales for full year have been at 11,014 numbers, a 38% growth over last year. Domestic aftermarket sales grew at 14% in Q4 over last year. On a full year basis, aftermarket sales were up at 31% over last year. Despite challenging circumstances, our operating profit grew by 91% year-on-year in Q4 and for a full year. Operating profit has turned positive at 17 crores from a 400 crore loss last year. We continue to generate cash and further reduced our net debt by 1,977 crores this quarter. Debt equity is at a comfortable 0.1 times. Cash generation for a full year was at 1,900 crores. During the quarter, we have launched 2 more models in CNG covering 14-ton and 16-ton respectively, which should help in growing our market share further. In parallel, exciting launches happened in tippers, 4825 and 2825 and multi-axle segments, expanding our range. I'm extremely confident that with these launches and the continued expansion of networks, we will sustain the market share gains achieved in the last 2 quarters. The domestic MHCV truck segment posted an improvement in sales volume in Q4, both on a year-on-year as well as sequential basis, with low bases in previous corresponding quarters. The uptick in the economic environment post-pandemic and the resultant improvement in freight availability supported these improvements. MHCV TIV has been growing since Q4 of last year, and this augurs well for the industry. There is still a lot of headroom for growth, given that the fleets are aging with average age between 9.9 years, as per ICRA, and the announcement of the scrappage policy is a step in the right direction. Macroeconomic indicators put India as a high-growth economy and an attractive market. With further demand growth, we are expecting pricing to be more rational. Increase in steel prices, which have resulted in significant cost push in the industry, continues unabated in Q4, and if this trend continues, we should see margin depletion for all the industry players. The situation on the semiconductors is also being monitored closely. For FY21-22, fleet utilization levels were on the rise as freight volumes picked up, thereby easing cash flow pressure for the operators. Russia-Ukraine conflict has driven the diesel prices up, leaving the spotlight on the fleet operators' ability to protect their margins through freight rate hikes. Freight movement indicators covering port, rail freight, FASTag, and e-way bill volumes have all improved as economic activity picked up. Ashok Leyland, even while growing market share sequentially, has been raising prices owing to a higher input cost. What is good to see is that the retention of such increases is getting better. I must compliment our MSCV team who have taken up a rationalization of our network, appointing new distributors where there are gaps to be filled, and are also working to further improve dealer profitability, which is crucial. A special team is working on expanding relationships with financiers. Upstar modular vehicles are doing extremely well and have raised the bar on industry performance. As volume grows, I'm confident that we will see the benefits of modularity. On the LCV front, both Dost and Baradost are exceptional vehicles and have been growing stronger by the day, and volumes are limited by the availability of semiconductors. Both these products hold immense potential for exports and are a perfect fit in our addressable market. Going forward, the growth drivers for the bus segment remain largely favorable, with increasing vaccination penetration, opening up of offices and educational institutions. This will add to our volumes and market share, as Ashok Leyland is a leader in buses historically. Aftermarket and international businesses continue to perform exceptionally well, and Power Solutions business, which again had grown significantly in FY21, is constrained by availability of ECUs. We are also putting effort in reducing costs, both product costs as well as overhead. You can see the effect of this in the improved margin. Switch is an important initiative, and I'm extremely happy with the progress that has been made. Switch India is operational with its own dedicated team. We have received statutory approval for transferring EMAS business to OHM Global Mobility India. We are in discussion with investors to raise capital both at Switch Mobility UK as well as OHM Global Mobility India for the e-mobility as a service space. We will let you know on the outcomes of these very soon. Finally, before we address questions, let me ask Gopal to share the financials in brief.
Thank you, Chairman. I think it's a very comprehensive introduction. I'll just run through the financials very quickly. Our revenues were at 8,744 crores, which was a significant jump over Q4 of last year by almost 25%. You can see the benefit of the operating leverage coming in. Sequentially, also when you look at the revenues, the Q4 jump in revenues has resulted in better operating margins. There has been a lot of middle line management, material cost management, which has actually helped it. There were negotiations in the fourth quarter of last year, the current term, in 21-22, which also saw some, volume discounts coming in. We were also able to kind of reverse some of the provisions that we didn't require at the beginning of the year because we were looking at incentives and stuff like that. All said and done, it has been a great quarter in terms of margins, in terms of the cash generation. We, as we mentioned earlier during the year, as the working capital was getting a little tight during the middle of last year, you would have heard us mention two things. One is that we would see the working capital situation easing off, and the second one is also that we would be, kind of increasing market share from the 18.5% that we were at last year in August to September. So we finished the year on the MHCV side itself. The total market share itself was more than 30%. The exit market rate was, has given the team extreme confidence that we are on the right path. The products are being well accepted, and our cash the net debt at the end of, the year was just about 0.1 times equity, which means our net, our overall debt was hardly about 700 crores. So with this introduction now, I'll hand it back to Chairman. If he has to say anything, then we can hand it back over to the floor for questions.
Yes, I think we're ready for questions.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to limit a question to 2 per participant. If time permits, you may join the queue for any follow-up. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Kapil Singh from Nomura. Please go ahead.
Hi, sir. Good morning. Congratulations to the entire team for a great performance. Firstly, I wanted to ask you about market share. It's seen a substantial improvement in fourth quarter. You have touched upon it, but if you could give us some more details on what are the actions you have taken that has helped, this thing improve so much. And also the CNG salience, how much is it for us right now, and, how many more models are required to be launched going ahead in both LCV and ILCV or MHCV space, whichever way you look at it. So for the industry, what is the CNG mix and where are we right now, and, some color on that.
So regarding the market share, I think if you look back the last 4 or 5 years, we have been at the 30% plus level. The last 2 years has seen a reduction, and I think 30% plus is the norm where we should be. What has helped us gain back our market share is definitely the addition of the CNG product. As you're fully aware, ICV segment has become the largest segment in the industry, and within that, CNG is 40% of the market. So our product was slightly delayed, but the market response has been very good. During COVID, in phase 1, our network in North and East, unfortunately, some of the dealers had shut down, and it took a little time to get the revival done. This has also come up very well now, and that has helped us to revive some of our market share in both of those markets. The MAV front is also seeing a revival, which is going well, as well as the tippers. But I would say, above all, the products are performing very well, which is appreciated by the customer, and we've been able to push through the reliability and the quality standards of our product to the customers even more. So I would say those are really the aspects which have allowed us to improve our market share. Gopal, would you like to add on the CNG side?
Yeah, I think, thanks, Chairman. As mentioned by the Chairman, I think there are 3-4 things that help to improve the market share, especially in the fourth quarter. There was a lot of focus that started to happen on the network, which you mentioned about. There was a complete refresh, realignment, bringing in new dealerships as well. The second one is, Avatar is proving to be a product which is reposed faith in by a lot of customers today, because they find that both in terms of build quality, total cost of ownership, fuel efficiency, especially in tippers, Avatar is actually kind of raising the bar. The third one is, as we had mentioned, the CNG product launch, which happened in the early part of this quarter, has been received very, very well. We have 4 more launches to happen in CNG. We would also be launching an AMT tipper, another variant of non-AMT tipper, because tipper demand is also kind of expected to grow. See, strategically what we do, and I'm going to finish with this for the next question, is, as Chairman had mentioned, we will continue to keep launching products and filling in the slots, which is what we are doing in MHCV, which is what we are doing in LCV, which is what we are also doing in exports. So we will keep on, kind of introducing products which will help us to have a larger, kind of share of the customer's pie. Very clearly, our goal is to continue to build our domestic business, grow the share, grow it profitably, grow the LCV business, which is very, very crucial for our vision of being a global top 10 commercial vehicle manufacturer, and ensure that we also grow our international business. Aftermarket and other businesses have also been doing exceedingly well, but we'll discuss that later. Back to you, sir.
I think more specifically with regard to the launch of the CNG products, we have the 14 and 16 ton that are in the market at the moment. And during the course of this financial year, we will have the full range of products available in CNG.
Thank you. The second question is on profitability. This quarter, Gopal, we've seen a great performance, particularly on other expenses. You've kept them very tight. Is there anything one-off here to call out? And as you look through going ahead, we've taken, I believe, a 2% odd price increase. Does that cover for the cost increase that you are seeing in 1Q?
You see, as far as the expenditure is concerned, I think the whole team has rallied together to ensure that we are keeping our overheads tight. To be candid with you folks, our administrative overheads have been at the level of 2014-15, not factoring in inflation, which means the absolute terms we have kind of hemmed it. And you must understand, when you're trying to post this kind of a growth and you're trying to also kind of work on the distribution and new products, costs typically tend to go up, but we have said that we'll hem it and use it for the right appropriate purposes, and hopefully we'll continue this trend as we move forward. As far as the pricing is concerned, yes, we have been raising prices. We raised it in November. We raised it in January. I think we raised it in March as well. And we have done a price increase even in April. The retentions have been getting better and better. And, so we actually see a traction not only in the market share going up, but we're also seeing the traction in retention going up. Hopefully with the softening in the steel prices, we would see benefits of one, operating leverage, as well as better margins in the coming quarter. But we'll have to wait and watch.
Thank you, sir. Wish you all the best.
Thank you. The next question is from the line of Mukesh Saraf from Spark Capital. Please go ahead.
Yes, good morning, and thank you for the opportunity. Firstly, previous quarter you had mentioned that the replacement cycle will start very soon, and so just wanted to get your sense on where we are now in the cycle. Have we started seeing fleet operators replacing some of these old trucks, and how do you see this going forward?
Hello?
We're definitely seeing that people are as we mentioned, that the average age of the trucks is nearly at an all-time high of 9.9 years, and so we are definitely seeing people coming back into the market, especially the fleet operators, and this is a lot to do with the government initiatives on infrastructure, road building. So yes, the replacement cycle has definitely begun.
Right. Any guidance or any sense you want to give us on, say, FY23, how the growth for the industry will be, and maybe how the mix will move for the industry in terms of tippers, any kind of guidance you can give us?
I think it's a little too. It has become very difficult in estimating how the markets are going to go. If we go by published data, then ICRA has estimated anywhere an MHCV growth of 15 to 20%, an LCV growth of around 10%. But like I said, the important thing for us has been that how can we make sure between these troughs and peaks, how we are able to sustain ourselves. And we've done a lot of structure during this downturn, which I believe, irrespective of how the market reacts, we should be able to hold our own and continue the market share growth.
And if I may add, Chairman, I think with the product launches that we are expanding portfolio, especially in CNG, I think we would actually have slightly better growth. That is our aspiration, because as we know, ICV is now today about one-third, in fact 35% of the overall TIV. Within ICV, we find that CNG is about, again, one-third, right? It's about 35%. So you have anywhere between 10 to 12 for 13% of the TIV being, factored in by CNG. Our CNG play has only started. So we still need to launch 3 or 4 vehicles as, mentioned by Chairman. So once we do that, we possibly will see a lot more traction on our ICV side itself. And with the tipper launches which is happening, with a lot of infrastructure play that is happening in the country today, aided by the government, initiatives, the more tippers that we have in the market, the better it is for us to, get a larger share. Let us see, and the play out on, if the semiconductor industry, if the semiconductor supplies get better, as Chairman had mentioned, we actually would see a greater play in the LCV part also. But let's see, I hope things pan out as the forecast tell us.
Right. Right. Thank you for that, sir. And just secondly, could you give a sense of your revenue mix that you saw in this quarter between, say, buses, MHCVs, exports, LCVs?
Gopal, please go ahead.
Yeah, thanks. So you see, basically, if you were to look at our revenues, right, I mean, while we can give a broad breakdown for the quarter, we have had domestic truck, our volumes have been, 28,733. 27,000 or 27,082. Domestic buses were at about 1,274. See, one thing we have...
So the revenue... I was asking about the revenue mix that you provided even the previous quarter.
You wanted the revenues, okay, not the volume. Yeah. Okay, our revenues, trucks were accounted for nearly about 67%, bus was about 2.3, light commercial vehicle at about 977 crore out of the 874 was 11.2%. So if you were to kind of add that up, about 81% of the total revenues were between trucks, buses, and light commercial vehicles. The rest was the other businesses.
Exports and aftermarket, basically. And the power and defense business will still be quite small.
Yeah.
Right. Great, sir. Thank you. I'll get back in with you. Thanks.
Yeah.
Thank you. The next question is from the line of Raghunandan from MK Global. Please go ahead.
Congratulations, sir, for stellar numbers. 2 questions. Firstly, can you talk about demand trends in export markets? How is the demand conditions in key regions and companies' initiatives?
Yes. We have, look, firstly, on the global trends, there are a lot of uncertainties, inflationary pressures, but for specifically the markets that we're operating in, where we are likely to see a lot more growth is in the African markets, because over the course of the last 12 to 18 months, what used to be predominantly project sales for us, we have established many new distributors who are very strong and have a large presence in these countries. So, and with the added product range that's available, they should be able to start growing the volumes for us in these areas. So Middle East, Africa, we feel will continue to see good growth. And the start countries, Bangladesh is still looking to be better than the others. I think Sri Lanka, unfortunately, you know what the situation is like. But the growth in our product range and the larger network should allow us to see a much healthier international operation sale.
Thank you, sir. My second question is on capex and investments. Can you indicate how do you see the capex plan for FY23? FY22 capex seems to be lower than planned. And on non-current investments, there is an increase in FY22 versus 21. Is it mainly due to reversal of impairment, or is there any other investments? Related to that, for Switch Mobility, what are the investments so far and any progress in the fund infusion?
Gopal, why don't you go ahead with this?
Yeah, I'll do that, and on the absolute balance sheet bit, I'll maybe ask Balaji to answer the non-current investment. See, as far as capex is concerned, as you know, as we had mentioned, we have been able to hem in the capex this year to about 400 and odd crores. So as we move into the new year, that I would actually kind of share it, and as Chairman can add, we are looking at rebalancing or steady state capex to be anywhere between 500 to 600 crores. Typically, that's what we see happening over the last few years. We don't see a significant change on that. In fact, there's a larger thing that is being driven in terms of the overall manufacturing strategy to see how much more efficiency can we build into the system. RPD rates actually have been, the manufacturing teams have done a wonderful job in driving the RPD rates, and the productivity has been common. So to answer your question, we see about 500, 600 crores of capex in the current year. The second one is, if we decide to expand the LCV portfolio, we are in discussions with that. I think that would be a separate capex, but then that would also bring in a huge separate capability as well. As far as investments into, Switch and other subsidiaries are concerned, let us wait and watch. If HLFL requires some, kind of capital infusion, we are very happy to support it, because for every rupee that we invest into HLFL builds the book 7 to 8 times on it. So it is something that we will be happy to support. So this is more for growth capital in HLFL than anything else. Maybe about 100, 200 crores at best. Not very significant at all. HLFL has been able to manage it through very well till now. As far as Switch is concerned, I think, as Chairman had mentioned, we are, kind of actively pursuing discussions with the investors. We would want to ensure that we have the right set of investors in the company, because this is very, this is a medium-term and long-term business. And we need to ensure that the investors that we have are aligned with our, kind of thought process also, because ultimately we are here to build a very good business, just like, we have built Ashok Leyland. If there is any funding support that may be required for Switch, for instance, from the Ashok Leyland side, we will have to provide it, and we'll be ready to provide it. But I think at the moment there is nothing that we can kind of share with you. As the debt equity of the balance sheet is just 0.1, we are very comfortably placed as well. See, so certainly we would continue to invest in growth, but we will do it the way we have been doing it in the past, very, very prudently.
Thank you, sir. That's all from my side.
Current bit. Balaji, can you add the non-current bit? Yeah.
Non-current, as well as the non-current investments, it is primarily because of the reversal of the impairment provision with reference to the Octave. That is why we are seeing the investment value going up from 3,068 crores to 3,500 and odd crores.
Got it, sir. Thanks for that clarification. Thank you.
Thank you. The next question is from the line of Abhinav Ganeshan from SBI Pension Fund. Please go ahead.
Yeah, thank you, sir, for the opportunity, and congrats on a great set of numbers. I just had a couple of broad questions for you. First is that when do you think, I believe that the CV cycle is turning, so when do you think...
I'm sorry to interrupt you. You're not...
Am I audible? Yeah. So I have a couple of broad questions. First is that when do you think the current CV cycle will be peaking? The cycle has turned. And second bit, I just wanted to understand on the financing piece of our MHCV and LCV part, how much of the total percentage of the vehicles is financed, and how much is done in-house, and how much other partners do it? If you could give some color. Thank you.
On the CV cycle, as you've seen, there is an element of cyclicality in this business. Typically, 3 to 4 years are seen as the boom, and then we do sometimes experience anywhere between 6 to 18 months. This time it has been a little longer as well. It would be very difficult to guess when we would see the peak of this cycle. With the growth commitment that the government has given, it is very favorable for the industry at this point of time. And considering that we have just come out of the recessionary trends in this segment, the next few years should continue to be quite positive. Gopal?
Yeah, I would agree, Chairman. I think, the CV cycle, there are certain, if you look at the large mega trends that have happened over the last 3-4 years, there has been a kind of reduction in the TIV itself, right? Of course, one part of it was COVID. The second part of it has been that the impact of the axle load norm seems to have waned. So it looks like there is fresh buying that is going to happen now because the axle load norms have been used up. The third thing that is happening is with the push for green energy and so many things happening. Very clearly, the larger corporates, chemical companies, oil companies, pharma companies, e-commerce companies, all of them want to ensure that their supply chain partners, which is the transporters, are using the latest generation vehicle and not a BS2 or a BS3 vehicle. So what is going to happen is, at the larger scheme of things, the government has announced the scrappage policy, but this is more a hint. It's more a hint that there is more to come. And we would actually see a lot of vehicles going off the road of the older generations, and there would be a replacement demand also coming in. Because of the trifurcation into long-haul, intercity, as well as LCV, what transporters are also doing is they are doing extremely sharp buying. The earlier trend was to buy a vehicle of 25-tonner or 30-tonner and then start using it for multiple purposes, but today it isn't anymore like that. People are becoming specialist transporters. We will see a consolidation in the industry, which is good for us. And you would actually see that each of these segments can be growing independently. ICV driven by e-commerce, LCV, of course, because of the last mile, that is, kind of the huge amount of, potential that is being held because of warehousing businesses and last mile delivery companies coming in. And, of course, the long haul coming in because of the larger growth that we are expecting in the, in the economy. So, core sectors are expected to grow. There is going to be infrastructure investments. Road building has become even more ambitious, with the government setting targets much, much higher than the 25 kilometers per day that we were looking at. So all of this seems to be auguring well for the industry. And of course, lastly, we have not talked about one important thing which Ashok Leyland is exceedingly good at, which is the bus segment. We were the largest bus, manufacturer in the country, and we hopefully will soon get it back. But we must remember that the bus industry, the total TIV was just a quarter of the total potential. In a good year, typically it's about 45,000 units. We were at hardly about 12,000 units, if my memory serves me right, because everything was shut. But now with offices opening up, schools opening up, colleges opening up, intercity travel would start to go because people will need to get back to their work cities and want to go back home. And once that happens, when the buses start to come back on the roads, again, I think that would also add to industry growth.
That was really useful. And if you could just answer the the financing part, broad color if you could give.
No, you see, the financing continues. I think, there is a little bit of, on the NBFC side, what is happening is there is a greater amount of strictures coming in, which is good from a governance perspective, but I'm not too sure how this will pan out in terms of operational things. But as far as the financing is concerned, HLFL is a very important strategic, finance company for us, because they fund Ashok Leyland customers, both in MSCV and LCV. But our financing is actually pretty well spread out. So aside of HLFL, we have, deep relationships with other financing companies as well. But we are also, HLFL is actually a full-suite finance company. It is not like the finance companies that either car companies have or some of our competitors have. They don't end up financing only for trucks or buses. So I don't remember the exact number, but approximately about 35% of the portfolio of HLFL would be, commercial vehicles. But other than that, it is actually pretty well spread out in terms of two-wheeler, three-wheeler, off-road applications, loan against property, and you have buy and sell down of various kind of debt instruments. So while we will, so the aspiration of HLFL management is to be a best-in-class finance company providing latest solutions for customers. For Ashok Leyland, of course, they are a very important subsidiary and a strategic partner for financing, extremely strategic relationships. While doing that, we also ensure that we are building, great relationships with other financiers. As far as loan to value is concerned, well, I'm not able to say that there is any significant changes, but actually the industry is moving to be a little less aggressive, which is good. Why is it good? Because then what happens, the trucker's skin is also there in the game. But no major shifts have been seen in terms of, and I think the collection rates have improved significantly. People are comfortable now because, this is a reasonably small ticket portfolio, but with a very large portfolio which banks and NBFCs are looking at. So I believe that truck financing is actually slowly gaining ground.
Thank you so much, sir. That was useful. That's all from my side. Thank you.
Thank you. The next question is from the line of Gunjan Prithyani from Bank of America. Please go ahead.
Yeah, hi. Thanks for taking my questions. Two questions. Firstly, on this electric bus, now we're clearly seeing a lot of noise in the industry, a lot of STU orders which are coming through. And, we have seen some of the aggression from, both the incumbents as well as the new startup companies. Now, just wondering what is our thought process there? How are we thinking about it? Where are we on the bids with the STUs? Some color on the strategy around this electric bus, because we do have a dominant share on the ICE business here. So how are we thinking on this?
Ashok Leyland we've now been operating the electric buses for close to 3 years, 2.5, 3 years. And so between Ahmedabad, Patna, we are also in Chandigarh and now coming into Bangalore and Mumbai. Over these years, with the experience that we've gained, we understand what the operational cost can be and what could be the right pricing model that we can get into these GCC contracts. And since they're long-term agreements, 8-10 years, we want to make sure that they will be positive and adding margins for us. And as you rightly say, some of these tenders are going on a very aggressive basis. We are not going to be participating in, let's say, a price war. We believe Ashok Leyland and now Switch has a good reputation and standing with the STUs. So we will bid, but we will make sure that we will be in areas where we believe that it will be with a positive contribution margin. The other area that we are seeing is increasingly the private sector for passenger, for their staff transportation is now also moving into this segment as well. And there we believe we could see a more positive and a healthier contribution. So in short, I would say that a lot of aggression in this market for gaining market share. But I think this would be very short term because in the long run, I do not feel people will be able to take on too many contracts with very low contribution and running for 8-10 years.
Got it. Do you have any expectation, how we are looking at the penetration playing out, any broader industry numbers, what penetration can we see in next couple of years?
Well, in terms of market indications, we'll be launching next month our European bus, and we are already in the UK, and we're seeing very good traction in the European markets as well. We're participating in many tenders over there. In the domestic market in India, I think you've seen that not only the central government, but the state governments, they're all pushing towards greener cities. To give an exact volume in terms of what is the TIB we expect, I think it's a little early. There are many tenders coming. CESL had a tender for 5,000. I understand that there's likely to be a new tender coming up once again in excess of 5,000 vehicles. But all of them have a long lead time as well. So the delivery time frame is not always within 6 months. They do reach out to 12 months as well. A little difficult to give you an exact answer on TE expectations.
Sure. And the second and last question from my side is on this, NXT Digital transaction that we did. Any, if you could share thought process around doing it. I mean, it makes sense from the terms of keeping it out But does it also mean that it becomes independent as far as the capital commitments in future go? Is that the way to think about it? This carving out of Leyland Finance and merging it with NXT, and any timelines as to when do we see this, concluding?
Gopal, please go ahead.
Yeah. Sure. See, we have not completed the transaction. What we had actually announced to the exchange, it was more out of good governance than anything else, was that both the companies are appointing investment bankers to study the transaction. So we'll come up with the details as we progress on the deal. See, the basic idea is that the management of HLFL is in discussion with investors. And some of them had mentioned that, they would be keen to look at an investment into HLFL for its future capital growth, provided they are also looking at a defined exit. So what we decided to do was, the NXT Digital is now a company without, it may, if things go well, both the boards approve. These are all subject to statutory clearances. So it is at a very early stage. But it is also kind of a company which is could be an ideal fit, because at the moment they are just sitting on some amount of cash and a very small amount of real estate which can be possibly liquidated. We'll have to study that. But other than that, there are no operating businesses which have to be merged. There are no post-merger integrations to be done, right? So if we are able to do this, it's a win-win for everyone. I mean, NXT Digital, Ashok Leyland Finance, as well as potential investors who will come into the company. That is how we are looking at this three-way match.
Okay. Thank you so much.
Thank you. Our next question is from the line of Hitesh Goel from CLSA. Please go ahead.
Yeah, thank you for taking my question, sir. I was just looking at April numbers for the industry, right, for MHCV. If we just annualize that, right, and April being not a very strong month seasonally, we should easily be surpassing 30-35% growth for the MHCV industry. So I was quite surprised with ICRA's estimate, and you also guiding to only a 15 to 20% growth. Are we started to see a slowdown after the price increase that we have seen in April, or fuel price increase which has happened? Can you shed some light on this?
I think, I did not personally want to give you any forward trend, but I was quoting what ICRA has given. April has been a stronger month coming back from March, and hopefully this trend continues. But, there are so many uncertainties that are currently in the global economic scene. So it's difficult to estimate. But from all indications, as I mentioned, and with the high expenditure that the government is committing on infrastructure, the year is looking very good and very...
Hello?
I think we missed the line.
Sorry, I was saying with the strong growth that the government has committed towards infrastructure, we feel that the year is going to be very strong, and especially in the MHCV segment.
Great. My second question is to Gopal. Gopal, if you can shed some light on when we look at the steel cost average in fourth quarter is close to 70 to 72 rupees per kg, where we are right now on the spot basis. So the price increase that you've taken in April covers for that, and if there is any subsequent reduction in steel price will add to the margins. Am I right on understanding this?
Hi, Hitesh. Long time. Your question is spot on. The price increase that we're taking is about 2.5% will not be sufficient for steel price increases. Let's understand where we see the potential in this business. There has been a price increase that has happened from BS4 to BS6. All of you guys know that. You're all experts. The second one is there has also been an increase in steel prices, which is, if you look at it from December 2020 to December 2021 or even now, has been quite a significant jump. Our price, and in between, what has happened is, please understand, there has been this COVID, right, where the demand there has been a demand vacuum. So the ability to raise prices has not been significantly there because there was no significant volume in the industry. So unless you actually start picking up volume, pricing has to be done in a, kind of stepped-up way. Our price increases, we believe, to the best of our knowledge, that our price increases have been higher than what the competition has been doing. And fortunately for us, with the excellent efforts of our team, we have also been able to raise our market share. This is exactly what we did in 2017 when we launched BS4. To answer your question specifically, has a 2% been enough to kind of neutralize the price increase of steel prices? No. But what are we planning to do? I think the first thing we are planning to do is to continue to pursue market share. That is for sure. The next thing that we are planning to do is, of course, to raise prices to ensure that the MHCV portfolio starts to become better in terms of contribution. The third thing we are hoping for is that steel prices will soften and there will be a price retention in the industry, which will then kind of improve the margins of the business even further. Fourth one is operating leverage. Try to get a larger amount of share through product introductions, network, etc., which will also help us incrementally to have a better margin by having a larger share of the market.
Good. So just a clarification, Gopal. My question was more saying that if I look at the gross margin, basically net sales minus raw material cost by net sales, that is 22% today in fourth quarter. You have taken a 2% increase in the first quarter. So that would offset the price increase which has happened in third quarter to fourth quarter because it comes with a lag. So this 22%, if the steel price don't go up from here, barring neutral mix, would be sustainable, right? Or there is some other steel cost which is yet to be.
It is sustainable. To answer your question, we are looking at the contribution over material cost to get better.
Yeah.
Okay, unless there is a further increase in steel price, which will not happen. The other thing that we're doing is also doing an astute management of the mix between businesses and within trucks also to within the product itself, which will help us to hopefully gain better margins as we move forward.
Great. Thank you. Thank you, Gopal, and thank you, Dheeraj. All the best.
Thank you.
Thank you. The next question is from the line of Amin Pirani from JP Morgan. Please go ahead.
Yes. Hi, sir. Thanks for the opportunity. Most of the questions have been answered. I just wanted to, get some clarification on the exceptional items on the consolidated side, because on the standalone you have a gain, on the console you have a loss. So can you just help us understand what specifically you have done in this quarter?
Balaji, you want to answer it or do you want me to take it?
The exceptional items are within the group companies. That is why you are seeing the effect of that is shown in the one of the group company, essentially Ashok Leyland. And when you look at the console level, the impact of that you will not see in the consolidation stage.
Yeah, I mean, just to add, what is happening is you have written back the investment of the impairment of Optare, right? And then we have also prudently taken off, we have also impaired certain other investments so that, we kind of, it also helps to rationalize the balance sheet. This is on a standalone basis because this is the investments that we have in the subsidiaries which is being either added back or kind of impaired. So there is a net benefit of around I don't know the exact number because I kept these papers in office, but around 400 crores or so. Now, as far as the consolidated numbers are concerned, this is nothing but the performances of all the subsidiaries and Ashok Leyland. So we are having certain losses which are there in subsidiaries like Optare, etc., which we know that that is how it is. But as we move forward, we are expecting that these numbers will start to reduce here.
And I think you've taken some impairment on Albonair. So any update on what is happening there and what's the way forward for that entity?
Actually, Albonair has been doing, in real terms, they have actually turned a little profitable. But, we want to also be a little conservative. We've known each other for so long. Over the past few years, if you notice, wherever we find that there is a necessity to take an impairment, we thought that it is safer, kind of more prudent to do that, which is why we have taken the impairment on Albonair. We had already provided 50% of it, but we thought that given what is happening in the world, the European market and stuff like that, we said, why don't we actually take this window and we studied the cash flows. We looked at the future potential of BS6 in Europe, etc. So So then we decided that it may be, prudent after evaluation exercise to take the impairment in the balance impairment of Albanar itself. But having said that, let me also share with you, and the chairman may also want to add, the investment in Albanar has actually paid off quite a bit. The entire BS6, the exhaust system, the nozzle, is actually, the doser is actually using Albanar doser. So, and that has actually proved to be a big advantage for us, because in the East, the exhaust after treatment system, which is there in our vehicles, which has got after the engine manifest, you have the DOC, DPF, and then after that, you've got a few other, kind of parts in the system. There is a significant, there is one piece which is the doser. That doser design is actually from Albanar. So we are using that, and that will continue. But we said that as a prudent measure, let us take an impairment in Albanar.
Great. So thanks for the detailed response. I'll come back in the queue. Thank you.
Thank you.
Thank you. Ladies and gentlemen, in the interest of time, we'll be able to take the last two questions from the participants. Thank you. The next question is from the line of Joseph George from IIFL. Please go ahead.
Good morning, and thank you for the opportunity. I had two questions. First is in relation to the NPAs in the system. So if you recall, if you go back in 2020 and maybe even parts of 2021, there was fear that because of NPAs, a lot of trucks are getting repossessed and they will come back into the system, etc. Could you give us an update on where this particular issue stands? Is the excess inventory in terms of repossessed vehicles completely flushed out, and as a result, replacement demand, etc., should pick up strongly? If you can give some update on that, it will be great. Thank you.
I would. Hello. Yeah. So I think this is a very good question, because in addition to the pressure that the axle load norms were creating, because suddenly overnight you had 20% of the truck capacity being available. We also saw that the vehicles had got repossessed and they were getting back into the market. Fortunately, we believe, what has happened from our own experience of the NBFCs is that the repossessed vehicle, most of these NBFCs had also kind of not only taken a prudent hit, they also kind of disposed of the vehicles as quickly as possible, because they also wanted to right-size their balance sheet. So we believe that the significant impact on repossessed vehicles coming back into the market and actually creating a competition for primary demand is possibly over. That would still this will continue as a cycle as long as vehicles are financed 95% or 90% from NBFCs. Repossession would happen. But one thing is, I think the level of repossession which was there in the past, which was COVID-induced, is no longer there. Wheels are turning. There is a demand that's happened. What we are seeing happening in the industry is the deals which are happening more are of the larger fleet operators more than the first-time buyers, first-time users. That is because some of the first-time buyers, first-time users are the guys who are most prone to defaulting, not the larger guys, because they have their credit, quality also to be maintained. Now, as the market moves to a larger share of possibly not larger share, more demand coming from first-time buyers and first-time users, you will see a little bit of the repo cycle happening, but that is anyway happening in the traditional NBFC business. Believe that the assumption at the moment, going by what is happening in the market, is that the repossessed vehicle sale is predominantly over.
Understood, Gopal. Thank you for the response. The second question that I had was in relation to margin. So when I look at Ashok Leyland's history with respect to EBITDA margin, you have hit 11-12% EBITDA margins in the previous peaks as far as the CV cycle go. And I just wanted to understand how you all think about potential peak margins in this upcycle, given that the prices of vehicles have gone up by about 20-25% in the last year and a half following BS6. Do you think the percentage margin of 11-12% is still achievable, or do you all think of margins as EBITDA per vehicle? I just wanted to understand the internal thought process there. Thank you.
Well, I would say that... okay, go ahead, Gopal.
Go ahead. No, go ahead. Chairman, please go ahead. That's what I was just suggesting whether you would
say that had it not been for the commodity price increases, we would have definitely seen, coming back to the types of previous margins that we had. And as Gopal mentioned a little earlier, we do feel that steel prices will begin to soften soon. And once that happens, there shouldn't be any reason why we should not be able to keep a double-digit EBITDA on a more regular basis. There are many, irrespective of the external factors, we are increasing prices. We are at the same time doing many cost reduction exercises internally, both on the product front and in our overheads as well. So the aspiration is definitely to ensure that we're able to maintain that double-digit EBITDA.
Thank you.
Thank you. The next question is from the line of Ronak Sada from Systematics. Please go ahead.
Yeah, hi. Thanks for the opportunity. First question is on how's the inventory in the system? Channel checks suggest the inventory is pretty low, around 10-15 days. And given a very robust demand recovery, do we see discounts or the net pricing improvement more than offsetting the entire gross margin pressure? Given discounts at peak have been nearly 15-20% of sales. So how do you see the entire net pricing movement over the next few quarters?
Gopal, you want to start?
Sure. You see, as far as the inventory in the system is concerned, I don't think there is any back pressure at all. This back pressure was there last year, where we had shared with investors quite, kind of candidly that we would actually be going a little slow on wholesale last year because there is so much of inventory in the system. Because unfortunately there was a COVID and the system just shut down, right? And the dealers were left saddled with a lot of inventory. And, we don't push wholesale beyond a point. We keep watching retail, wholesale, retail, dealer-wise, geography-wise, so that's the best and the more credible way of growing share of business. Now, sitting as we are here, I don't think there is any major inventory issues that dealers are facing. In fact, there is demand that sometimes we are not able to cater.
I'm saying inventory is very low in the system at this point of time. So, yeah.
So the other thing is, as far as pricing is concerned, the discount levels have, at slightly elevated levels even now. But with the price increasing that has happened, the retention of the price increases, at least at Leyland, let me tell you, has been very good. Typically we have raised prices, say this is an approximate number, but say if we raise prices by about, say, 2%, we are able to retain, say, about 1.6 to 1.7% net. Similarly, if it's about 2.5%, we are able to do about 2.1%, which is very, very good. You can never retain the entire 100% pricing even in good markets. This is one part. As we move forward, I think we may need to raise prices, but, as Chairman had mentioned, as I had mentioned, we also want to ensure that we are growing our market share methodically and steadily. So this is going to be a good balance between what our sourcing team is able to do with vendors, what our product design team is able to do on the product cost, what our front-end marketing team is able to do both on market share and pricing, and hopefully the synchronicity of all of this will result in better margins as we move forward.
I think just to add on what Gopal has said, production from our internal perspective is not really much of an issue, and we should be able to ramp up in terms of the market demand. The only constraint seems to be on the semiconductor chip, and as we understand, in the next few months, this should also start easing. And we will always take a very measured balance between these commodity price increases and the availability of the chips as well. But specifically, as you said, inventory might be on the lower side, but we don't see an issue in terms of ramping up.
Got it. And Dheeraj, a question on the electric vehicle business. So how do we see, you mentioned experience on the India side, but if you can share some experience on seeding the global markets for buses, for light vehicles, SCVs, LCVs, if you can share some experience on the global markets as well.
Yeah, I mean, generally, I think as you've seen, the government overall are looking at a substantial growth everywhere and making sure that they agree to the COP26 commitments that they've made. But if you look at the electric bus business specifically, leaving aside China, the current sales volume is around 1.4 billion. Based on the studies we've done with McKinsey and other consultants. And this is expected to grow to about 16 billion. And when you look at electric light vehicles, currently they're at around 4 billion, and this is likely to grow by 14 times to 55 billion. So the growth rate and the potential in these segments are very strong. And this is equally distributed. That's China specifically, because the Chinese market has been ahead of the curve in electric for many years. But all the other markets from the U.S., Europe, and also in many of the Middle Eastern markets, we are seeing that they are now wanting to move into electric buses as well. So all in all, I would say quite a robust scenario going forward for electric vehicles.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to the management for the closing comments. Thank you, and over to you.
Thank you very much for your questions, and I hope we've been able to provide more clarity for you. I would just close by saying that we have shown in Q4 a strong turnaround, and the year ahead looks to continue in this similar manner. And we, as Ashok Leyland, will continue this growth as you've experienced in Q4, but in a very profitable manner. We will not be buying market share. We want to continue this market share growth and continue to grow our margins as well. So thank you once again.
Thank you very much.
Thank you. Thank you.
Ladies and gentlemen, on behalf of Motilal Oswal Financial Services, that concludes today's call. Thank you all for joining us, and you may now disconnect your lines. Thank you.